inflation is potentially a huge problem and a huge threat, but in my view, it's not coming. It's just about over, in the sense that we've seen peak inflation as of now, and it'll start to go down a lot faster than people expect. In April, May, and June, I'll say even into July, I actually expected the inflation. If you look at April, May, June, July 2021, year over year, what was going on in April, May, June, July of 2020? That was the worst depression, worst collapse of the US economy since 1946. The determining factor relating money supply to inflation is velocity, which is the turnover of money. That's a psychological phenomenon, behavioral phenomenon, which the Fed cannot control. It's not predictable, and the reason is money supply is irrelevant to inflation. I know that's sort of like an apostate view for the Austrians and monetarists in the audience, and I have a lot of respect for all the work that's been done in that field from Irving Fisher onward, but it's not the determining factor. So rising prices, here's what you have to ask yourself. Why are they going up? Okay, and is it sustainable? Is this something that's going to continue? It has nothing to do with money supply. You know, your typical Austrian economists, monetarists, they say, well, the Fed printed all this money and that's what's causing inflation. In April, May, and June, I'll say even into July, I actually expected the inflation, as did a lot of analysts, and there was a reason for that, which has to do with what are called base effects. You have, not to get too technical, but you have to know how the government calculates inflation that we all read about in the headlines, and they take it monthly, but they do it year over year. So April 2021 was compared to April 2020, May 2021 was compared to May 2020, and so forth. And that's just how they do it. Then they take the monthly year-over-year increase, they annualize it. There's a little math, but basically times 12, a little more to it than that, but that's basically it. And then that's the headline number you hear, up 6% or up 7%, et cetera. It's not predictable, and the reason is money supply is irrelevant to inflation. I know that's sort of like an apostate view for the Austrians and monetarists in the audience, and I have a lot of respect for all the work that's been done in that field from Irving Fisher onward, but it's not the determining factor. If you print money, you're going to get some growth, you're going to get some stimulus, and you're going to get some inflation. The reality is it doesn't work any more than the Fed printing, $3 trillion since the beginning of 2020. That hasn't created growth. That hasn't stimulated anything. So the point is, if the money is being spent, if the money is being, like you say, through the banking system, if it's being turned into more money with more credit and leverage, et cetera, it could possibly have a stimulative effect, but that's not actually what people are doing. They're paying bills, paying debts, or saving it. So in other words, the global velocity problem is no different than the national velocity problem. It's not there. No one has any confidence. If you look at April, May, June, July 2021, year over year, what was going on in April, May, June, July of 2020? That was the worst depression, worst collapse of the US economy since 1946. So yeah, not only, go back to 2020, prices are actually going down. So when you got to 2021, you would expect them to go up. That would be perfectly normal in a year-over-year comparison. There's some of the better analysts actually. So let's use 2019 as a base year because it was unaffected by COVID, but be that as it may, so you expect it. So the question was it transitory, in Jay Powell's famous word, or would it peter out? Well, you wouldn't find out until the fourth quarter of 2021, because if you and third quarter and fourth quarter, because if you go back to 2020, the economy was booming in the third quarter. That just as the second quarter was the greatest collapse, one of the greatest collapse. Third quarter was one of the greatest increases. So that would tend to erase the base effects, and you'd be looking at something closer to, real inflation or something that might be persistent. The determining factor relating money supply to inflation is velocity, which is the turnover of money. That's a psychological phenomenon, behavioral phenomenon, which the Fed cannot control. The Fed can control M0. They can stick the landing. They can make that number whatever they want, and they have. I'm well aware of the growth that you're describing. But velocity, just to give a simple example, if I'm feeling good, if I'm feeling prosperous, if prospects are good, and I want to go out to dinner and take my friends and drinks on me, that's one state of the world. And I tip the waiter, and the waiter goes home and takes an Uber, tips the Uber driver, and the Uber driver puts gas in his car. Well, in that example, my money has velocity of 3.
So rising prices, here's what you have to ask yourself. Why are they going up? Okay. And is it sustainable? Is this something that's going to continue? It has nothing to do with money supply. Your typical Austrian economist, monetarist who say, well, the Fed printed all this money and that's what's causing inflation. It's not true. The Fed has printed the money. That part's true. You can just, that's public data. They printed $5 or $6 trillion of base money. But they print it by buying bonds from the banks that, they pay for bonds with money that comes out of thin air. They get the bonds, put them on the balance sheet, and the banks get the money. What have the banks done with the money? They gave it back to the Fed in terms of excess reserves. So you're inflating, but you're increasing both sides of the balance sheet. You're increasing the assets and you're also increasing the excess reserves. But the money didn't go anywhere. That money did not get out into the real economy. For that, you have to look at M2, or M1, you have to look at what the banks are doing. Are they making loans? Are people borrowing money? Are the bank balance sheets blowing up? And the answer is no. They're just buying government bonds. And so, they can make money doing that as long as the Fed holds down the Fed funds rate or by extension, the repo rate. And so there I would say when we got to September, October, November, even now we have some December data, that inflation has persisted. So it did last longer than I thought. But I'm sticking with the view that it's going to go away pretty quickly and we've seen the peak. In last summer, I was a little uncomfortable because the Fed was saying transitory and I was saying transitory. But one of my thesis, the way I do a lot of analysis, is that the Fed is always wrong. So I was very uncomfortable being on the same side as the Fed. It's like, maybe I'm missing something if they agree with me. But Jay Powell has thrown in the towel and they've flipped. So now they say it's not transitory, it's here to stay. So I feel much better saying it's transitory because now I'm on the opposite side of the debate with the Fed. Although I will say what Powell did was highly political. He got renominated by President Biden. Okay, that means you have hearings. That means you're in front of the Senate, and you're going to get grilled on inflation. So he had to get on the right side of the trade, so to speak, in order to mitigate some of the damage. It's one thing to say you're ahead of the curve. It's behind the curve, rather. It's another thing to say you're still behind the curve. But he's doing the best he can. They said they're going to accelerate the taper. Yes. That implies that they're going to accelerate the liftoff, meaning the first interest rate hike sometime in late 2022. The market, at least the futures market, Fed Fund futures market seems to agree. So he's sort of positioned himself for the political grilling, but I don't think he's analytically right. I think we're now, it did last a little longer than I expected, mostly because of gasoline and autos, but they're real things. You got to buy them. But now I expect the inflation to come down very quickly. April, May, and June, I'll say even into July, I actually expected the inflation. Inflation is potentially a huge problem and a huge threat, but in my view, it's not coming. It's just about over in the sense that we've seen peak inflation as of now, and it'll start to go down a lot faster than people expect. So rising prices, here's what you have to ask yourself. Why are they going up? Okay. And is it sustainable? Is this something that's going to continue? It has nothing to do with money supply. Your typical Austrian economist, monetarist who say, well, the Fed printed all this money and that's what's causing inflation.